Stop messing around, stop fooling around, stop delaying, stop procrastinating. Get up, get out, get it done. Everything is possible, nothing is a problem, and anything can be overcome. I just get my ass up out of bed, I get my shit together, and I get out and I start the fight. And that will transform you from a mere mortal into a superhuman being. I've never, ever, ever met anybody who told me that they got rich watching their IRA or their 401k. There's so much duping going on everywhere. You gotta hope and believe in your heart that getting a vaccine for a virus made by our own companies and issued to us by our own government would not be like this crazy situation that would go bad.
Yeah, when I was younger, I think I often felt rightly suspicious of authority. But at some level, there's always some kind of trust that has to take place in human society.
We've spoken about that before. I mean, when you govern and legislate and make rules for the masses, you have to make a box. And you're making a box to fit 90 or 95 or some high number, the highest number that you can achieve into that box. And then there's those that just fall outside of the box. And there's words for that. You can't please everybody all the time. You can't make everybody happy. Collateral damage. I mean, that's an extreme phrase for it. But, you know, there's all these different ways to verbalize those that don't fall within the structure or the box that government and society sets up as boundaries for us and rules for us. So if you're making the rules or writing the book, your goal is to make it work for as many as you can and try and minimize the amount that it doesn't work for. But ultimately, it doesn't work for everybody, whether it's Social Security, whether it's laws and rules of society, whether it's fiscal policy, whether it's tax code. There's no way to please everybody and make it work for everybody.
Well, and that's where you get into the debate of centralization versus decentralization. You know, more federal government, more state government, that kind of thing. That the people that are in favor of decentralization would say, well, the states or the local governments know more about their populace than the federal government does.
Right.
And so, but it's always a back and forth.
Yeah, I always appreciated the agility, speed, efficiency, and tactics of small organizations and institutions, entrepreneurs, companies, things that were local, that were small, regional, that were lean. They could move, they could make decisions, they could implement. When you increase in mass and when you increase in size and you're handling more volume of people and communications and money and issues, there's flagpoles, you got to run things up, you have to have different levels of management, different sign-offs and approvals. I mean, trying to get a large company to make a quick decision is, it's like an oil tanker trying to make a sharp turn. It just can't happen. Analogous to what you were just saying at the state level, managing people. I mean, I think the states are a little quicker and more nimble and more boots on the ground with knowing how their constituencies and populations are living. And what they need.
I mean, that reminds me of what you said about, kind of why you have consolidated your properties.
If I can't get there quickly, I'm not buying it.
Yeah, exactly. And you said part of the reason you do that is that it allows you to keep the management team smaller because everything's more efficient, everything's more effective.
I think about that a lot because I imagine, well, what happens if I have properties in Austin, Texas, or Nashville, or some part of California? Something happens. Now, I have a property manager who at that point would likely be a third-party property manager. They're going to be the ones running the day-to-day. I have to meet with them. I have to try and get the data that they're giving me, process it, understand it, as if I'm there myself, but I'm not. Maybe I have to hop on a plane and go down there for a couple of days. I mean, that's the way the world works. When you've got assets located in all these different locations, hop on a plane, get down there, have your meetings, walk the site, leave the next day. Maybe I have to do that. Man, does that just sound, for me, so distant from my core business values. By the time I book a flight, get on a plane, the party's over, man. It's gone. I need my person on the ground to handle it right then and there before it escalates, before the seed gets implanted in the tenant or the vendor's mind or whatever the issue is, right? Like you want to crush it. Like imagine someone says to their other half, they get down on one knee, they say, "Will you marry me?" And then there's like a dead silence, there's a pause, and it's like cut, and then we pick it up in a few days. Like the moment's gone, right? I mean, but people, that's the way people are, and with all sorts of communications and dealings and experiences throughout their day. So I always appreciated having my portfolio of properties built out within a very tightly defined region so that I could get to them. My team is right here. I have access to them. We can tour sites on the same day, the same moment. I mean, it's so important for me. I just didn't want to be flying or driving all over the place all the time. So it was just a clear, easy decision for me to make to just focus on a few key areas and grow within those areas. I don't know how the guys do it that have properties all over the world, all over the country, and they're asset managing from their office wherever. You know, they have these third-party managers on site, and they have to incentivize and pay these managers. You hope they're doing a good job. Yeah. And I always felt like, for me, I'm in the value-add business, so I want to be the one to see the opportunity, seize the opportunity, and then execute. Yeah. And I just can't do that if I'm too far away, if there's too much distance between myself and the opportunity. And I don't know if my third-party manager is going to be able to either. Yeah. I built out my own property management company because I feel that I can do a better job managing property than third-party property management companies that I have to hire and pay for a fee. I'm going to get their version of what I want, and it's not going to be really what I want. Yeah, they can check the boxes and they can say, all right, we'll give you reports, we'll lease it, keep everything fixed and maintained, we'll have cleaning crews once a week, whatever the deal is. That may work if it's Class A construction, if it's not value add, if it's, not in a highly competitive environment. But, everywhere is a competitive environment these days. I don't want some unmotivated, unincentivized person making business decisions about my asset that I get a report on every month or every quarter or every year. I mean, by the time I get the report, it's over, man. Like, you got to be ahead of it, not behind it. You got to be on the ground looking at the situations and involved in the situations as they're happening so that you can motivate and inspire a result. If you're looking at a report of what happened last month, the boat sailed.
Do you have any peers or colleagues that implement third-party managers?
Yeah, well, I have a lot of people that I know that are huge multifamily owners and operators, and they're national, and they have tens of thousands of units located in every great market everywhere, and they have property management relationships with people on the ground in those markets. I mean, it's the best option there is. I don't know anybody that owns their own property management company that deploys their own people into these buildings everywhere. But, you form partnerships, you hire these property management companies. It's never, to me, it's never as good as if you're managing it yourself. I just never loved the additional layer or layers between my own sensory capabilities and the situation that was happening on the ground. I never liked to have that distance. I want to be there. Yeah. Like it seemed like it's like having virtual sex or like you're not really doing it. Like you sort of get the gist and but it's not, you're not really there. My solution for our portfolio was that I just formed my own property management company a long time ago and built that up, and it's my own team that goes into the buildings and manages the buildings and has the tenant relations and has the vendor relations. And it's our people. I set the culture. I set the expectations. I set the goals and objectives that everybody's working towards. It's very important. Without clear sets of goals and objectives, what's everybody doing? So I'm just imagining if I have a third-party property manager in all these different markets all over the country, and I have to have different goals for different markets and different people, but they're not my people, so I have to call up the owner of the property management company and say, can you give me someone else? The person you have there isn't that great. I don't know, just...
How early on did you do that?
From the beginning.
From the beginning.
I started small, so I self-managed.
Right, yeah.
And then I grew into a property management company, and then I had employees, and now here we are today with a real staff and a large staff and a lot of assets under management that we manage ourselves. So I'm both the owner of the property management company and the owner of the buildings.
And you would recommend that to most people looking to get into ownership?
If you're an entrepreneur and you want to build up your multifamily portfolio, you're going to start small. You're going to start with 1, 2, 3 units, 5 units, 10 units. right? We've talked about the growth trajectory. You're going to build that out. You're going to manage that all yourself. At some point, if you go to a different market, if you go to a different area other than where you're used to operating in, you're going to need someone to give you a property management solution in that market.
Right.
So you either got to do it yourself or you got to hire someone. That's the only way to get it done. For me, there's just too much money that I leave on the table if I hire someone else to do it. I'm in the value add business. I'm not building ground up new construction Class A assets. I'm buying existing occupied assets that are already cash flowing and I'm repositioning them and adding value to those. So in my value add efforts, I can't leave that to anybody else. We got to oversee that and execute on that ourselves. There's too much money that you leave on the table. There's too much risk.
Yeah, no, that makes sense. You mentioned working with your team and creating the company culture and all those kinds of things.
Yeah.
How do you motivate your employees? Do you have any tactics that you kind of motivate your team? Or
I don't really have tactics, but I'll tell you, you're talking about working with a team, building a team building, leading. Yeah. I mean, these are people skills. People, we all want the same thing. We all want to feel appreciated. We all want to feel like we can be successful. We all want to make money in whatever our chosen field is. We want to take care of our families. We want nice things for ourselves and for those that we love. We all want the same things as a species. For me, I want to have a great place to work. I don't want it to just be some shitty, benign, average office place. I want it to be great. And what makes that great? For me, a great place to work is a fun place to work where people love their jobs and love what they do. And that starts at the top, so it starts with me. I love what I do. I love my job. We operate our office in a town. We're very involved in the community, so we're often going to different events and places and businesses and restaurants and things within the community. And we spend a lot of time together. We're very connected. We're very centralized. We're not decentralized. We don't have an office in northern New Jersey and another office in southern New Jersey. I mean, we have one office and this is where we all are. And if we need to get somewhere, we get there, but our nucleus is here. And, you got to make it fun. Setting clear goals and objectives, I think, is number one. People have to know what they're working towards. And everyone's got to be on the same page. If there's a lack of that, people are just going to be flapping in the breeze. No one's really going to know what the deal is. You're going to have disjointed membership. You're going to have rustles in the ranks. It's not going to be great. Obviously, you have to pay people appropriately. And don't be afraid to overcompensate in some cases, because the cost of losing people is so expensive and detrimental to your business that for a little bit more money, you may as well just do it anyway. There, I said it. There we go. Now look, if the person's a horrible team member, they're not long for the world anyway. You may need to think about whether you want to keep them or not. But we're not here talking about that. We're here talking about how to motivate people. Celebrate the things in your team members' lives. We have weddings in our office. We have babies being born this year. We have things that go on, and it's important stuff. I mean, the people that you spend your time with, your team, these are who you spend a third of your life with. And so you got to be connected with these people. And we've talked before, George, a lot about how real estate's a people business and connections and relationships are everything. Well, here we are talking about it again. Have those same connections and relationships with your team, and I think you'll go far. Definitely have clear, defined goals and objectives. Everyone should have a clear set of goals that they're working towards. That way you can check in on them monthly, quarterly, annually. How are we doing? Are you achieving your goals? Yes, no, why not? And you can have a real discussion. If there's no goals, the annual review is pretty benign. It's like, well, hey, how do you like your job? You're getting a raise, you're not getting a raise. What is that all based on? Hey, you've achieved your goals. You worked really hard. We said you were going to sell 100 widgets. You've sold 113 widgets. That's amazing. You have to have that measurement device in place in order to create that connection. You can't manage what you don't measure. Have clear sets of objectives and goals for everybody.
Well, and I heard recently someone talking about how if you don't have those goals, it's very difficult to have that conversation because then it always becomes personal. It becomes, you're either doing a good job or you're doing a bad job, and it becomes about that person.
Based on what?
Right, exactly.
Based on my opinion?
Right, exactly. It becomes a preferential
You have
thing.
to have measurements.
Yeah.
You have to have measurable goals and objectives. Without that, you got problems.
How do you, as a property owner and manager, think about lease duration? Like, how do you decide whether or not a tenant is, going to be there for a year, 2 years, month to month? How do you decide that kind of thing?
Good question. So it depends on the arena in which I'm operating. Most of the time, our standard lease offerings are 12 months or 13 months if we're giving out any concessions. It has to match with the concessions that we offer. Sometimes at renewal, we'll go to 24 months at renewal. It depends on the maturity of the rent, and it depends on the delta of the mark to market. So the mark to market is where the rent is now and where it's going to be in a month, 6 months, 12 months.
How do you typically predict that?
Well, we know what the marketplace is. We know if a one bedroom goes for $1,500 and someone's in an apartment and they're paying $1,480, we know that we're really only going to be able to realistically offer a $20 or $25 renewal to bring them up the market, to mark them to market before they say, oh, anything more than that, I'm just going to move. Right. Yeah. Because I can go down the street for $1,450 or $1,525. I can go down the street the other direction for $1,780 and get a way better apartment. So then they start to get into price value comparison. But if you want to renew people, you got to be an expert in your market. For mature buildings that are in markets where rents are already fully mature and where they're fully marked to market, we'll often elect for a 2-year renewal so that we do away with having to renew them again in 12 months and risk the vacancy in 12 months. Instead, we give them maybe a little bit of a signing bonus. Again, it depends on what the metrics in the marketplace are, supply and demand, pricing, but we know all of that. A lot of these bigger companies have very sophisticated computer programs that tell them that. Never understood it. I'm not that big that I need those computer programs. I'm an expert in all of my markets and I know every product and what it rents for. I just know the deal. Yeah. These computer programs will tell you what your buildings in Austin should rent for and what your buildings in Memphis should rent for. I don't need that because in the markets where I am, locally, regionally, I just know what everything rents for. But you have to know your market. You have to be an expert in your market. And you have to know what the sensitivities are to tenants. I'll share with you that as a property owner, you're more likely to get a little bit more of an increase if you do a few things. So number one, if you provide great service. I can't say it enough, George, we beat it to death sometimes. You got to provide great service. Anybody can go to any building and just get keys and move in. But as the property manager managing that landlord-tenant relationship, provide great service. The next thing you have to do is understand your price sensitivities for a dual occupant situation where they're sharing rent. There's 2 people in an apartment, a 1 or 2 bedroom perhaps, and they're sharing rent. Both occupants are earning income. You could perhaps squeak out a little bit more of an increase, but don't just do it to be greedy. Provide something in exchange for it. Give value for it. So in the example that we used a moment ago, going from $1,480 to $1,500, because that's what the market is. If there's 2 occupants in that apartment, maybe you go from $1,480 to $1,525 and you're $25 above the market price. But what are you going to do for that? You can give signing bonuses. You can go to local businesses and give gift cards. It's going to cost you more money if they move out and you have to sit on it for a few weeks or a month and re-rent it. You're going to lose that 1 month of revenue. 1 month of revenue in that example is $1,500. So it may behoove you to spend a little money to give some value in exchange for the renewal. It may behoove you to go and visit your resident in their apartment and say, let's take a look. Can we do anything for you? Can we get you a new ice maker? Can we get you a new dishwasher? Is everything working okay? Oh, I see there's some paint that's sort of not looking that great around the shower area where the steam builds up. Let's get that repainted. Fix things, provide service, provide value, make your residents feel like they're getting something, not only for the monthly rent that they pay, but at increase time, at annual renewal time. Make sure they feel like they're getting something. Otherwise, you're just going to tire them out and you're going to create fatigue in the landlord-tenant relationship.
Do you do like an annual walkthrough to kind of determine the state of things?
We're in and out of the buildings all the time in our business, so I'll share a secret with you. It's a good question. We have a lot of point of contact with our residents. We do monthly extermination service, so we're in the units then. We can see what's going on usually. We have a high degree of communication, at a very sophisticated level of communication with all of our residents. Because we're constantly having to interface with them on parking needs, car needs. People get new cars, they need to register the new car with us so that they don't get towed. In the wintertime, it's snow plowing and different services that they'll need so they can pull out of the parking lot. In the summertime, when it's very busy here, we have a lot of buildings in the coastal New Jersey area. It's a very popular, very busy area in the summertime. Parking's at a premium. Sometimes people will come in and who shouldn't be there, and they'll park in the lots and go to the beach. Well, our residents call us and say, hey, there's an unauthorized car here. We have to go and so we're constantly communicating and speaking with our residents via phone, text. The online portal is the main way. I suggest that anybody with more than 50 units get an online portal, some sort of web-based platform where you can communicate, and it logs everything and it keeps everything nice and organized. But there's so many different opportunities to have touch points with your residents. We have many, and in those touch points, we get to assess what their experience is and how their apartment is, and if we can do anything for them. We're constantly saying to our residents, how are you? Can we do anything for you? And I think it's a great idea. If you're not doing that type of communication, try it. It can't hurt, and it can only make things better. We usually know what's happening in our residents' lives. We usually know if there's a change of employment, if there's a need for a pet, or a pet waiver, pet permission, if there's another occupant that moves in, there's a separation, there's a joining of people. You know, people get together and split up all the time. And it impacts your real estate. You have to issue keys, you have to issue passcodes. You know, everything has to get managed and dealt with. Well, we're pretty on top of it, and we use those opportunities to try and figure out what the needs are of our residents, and we gotta satisfy those needs. You need to satisfy their needs too. Find out what your people need, give it to them within reason, give it to them, and sometimes go the extra mile and go beyond and give it to them, because they're gonna renew with you at the annual renewal for $1,525 instead of $1,500. And you might say, well, why do I have to do all that, Peter? It's only $25 above market. What do I need to beat myself up over for the extra 25 bucks? Look, if there's two people in the apartment, they're going to split it $1,250 a person. For $1,250 a person, they're going to say, oh, we've got a warm body that we can call and interface with. Anything happens, they deal with it in 4 seconds. We like living here. Let's stay. It's valuable. As I said, if they move out, you've got a $1,500 loss because you're going to be empty for a month until you re-rent it. Hey, you're going to be lucky if you re-rent it in a month. It might be a month and a half or 2 months. And then it's going to cost you $2,500 or $3,000. You got to give value to get value, and that extra $25 above market that you may be able to get if you provide the great service, if you provide the great communication, is not just the $25 a month or $300 a year. But remember, it's one unit amongst many. And if you can achieve that on a global scale across your units, you're now adding a lot of value, because the value of your property is directly correlated to the income that it generates. If you can generate more income, you're generating and adding value.
Yeah. You know, not to mention that if the tenant really enjoys where they are, that if somebody asks them, oh, you know, where should I live? Word of mouth is going to help, you know.
Totally, George. And you know what? If you've got one unit that you can increase $25, that's $300 a year. If you've got 10 units that you can increase $25, that's $3,000 a year. If you've got 100 units that you can increase $25, that's $30,000 a year. You want to know what? If you apply a market cap rate to the $30,000 a year, you've now just added a shit ton of value. Learn about cap rates and the impact of incremental rent increases and the effect that cap rates have on those rent increases, because you're going to really add value to your building.
Yeah, so forgive me, I'm still new in learning all about this, you know, real estate business. What is a cap rate? How should we understand it? What do we need to know about it?
So cap rate is short for capitalization rate. It's the number that tells you what your return on your equity investment is into the building if there was no mortgage on the building. So if you buy a building for $10 million, cash, no mortgage, and it throws off net operating income of $150,000, you now have a 15% cap rate.
Got it.
Cap rate equals purchase price divided by net operating income. Purchase price equals cap rate divided by net operating income. So you can do the math and triangulate. As long as you know two of the figures, you can always find the third, right? Basic math. Yeah. So cap rate is a really crucial metric in our industry because it's a value of the health of your property. It's a value that measures how much debt you can afford to take on and service. When you go to apply for a loan, the only thing that the bank is looking at is the cap rate. They want to look at your net operating income and your cap rate, and they want to see how much money is there so they can size a loan to that net operating income. They're going to know if you're overpaying or underpaying for the building. They're going to know if you're borrowing too much money or not making enough of a loan request based on the net operating income and the resulting cap rate. So cap rates drive everything in our business. It's important to understand, though, as crucial as the cap rate measurement is, and everyone has to become an expert on cap rates. So if you're in real estate, especially income producing real estate, get to know cap rates immediately and become an expert. But what's also important, we talked about being an expert in your market. So you also have to know what cap rates could be if you do X, Y, and Z. So for me, I'm in the value add business. I often will have no problem accepting a lower cap rate. So by the way, the lower the cap rate, the more expensive. Right. The higher the cap rate, the less expensive. So I will often have no problem paying a lower cap rate or a more expensive price per pound for a building if I know that after I do X, Y, and Z, renovate, new roof, landscaping, new plumbing, electric, new kitchens, new baths, right? X, Y, and Z. I know that after I do those things, rents are going to go from here to here, and my income's going to go from here to here. My cap rate is going to go from here to here. So I'm going to add value. And I add value by increasing income. And when my income increases, my cap rate goes down, adjusts accordingly. So don't be afraid of a dynamic cap rate where you can influence it and impact it by adding value and doing renovations or increasing revenue, however you can increase revenue at your particular site. You know, these Class A newly constructed assets will often sell at a premium cap rate. You'll pay a lot for these buildings because they're newly constructed, they look great, they're brand new, they're not falling apart yet. So you might have a seller that's going to argue with you, look, you're going to have lower maintenance, you're not going to spend a lot of money on upkeep and maintenance and fixing stuff, you're going to staff it, and it's really going to be easy for you to run. Overpay for it, and a lot of people do. And with the value add buildings, with the vintage buildings, with the older buildings that you're going to get from the longtime owner, longtime manager, these sellers who have been in these buildings for a long time, you're going to find the value there. And don't be afraid to really play with cap rates. Sometimes you can make an argument to overpay for some of these buildings because you can get rents to really go in the direction you want them to go and add the value that you want to add.
And that's been the sweet spot that you've worked in for a long time.
It is.
So, yeah.
And look, we own and manage some newer assets as well, but we're always looking to add value to those assets. You can add value just with the relationship with your resident. You can add new products and services. Laundry, parking, storage, pets, outside areas, children areas. We don't have a lot of buildings that have a lot of kids in our particular market, George. So that one's not one that we deal with. But in other markets where we have buildings, we have to put in playgrounds, and we have to put in safety features, and we have to put in package delivery rooms. And these are all amenities that people want and need in 2021. And if you do that, people will pay you a little bit more for those amenities.
When you're shopping for lenders, is there anything that you look for besides just qualification? And are there any red flags?
For commercial loans?
Yeah.
So the commercial loan market in our markets, in our areas, and I have to say probably in the rest of the country, no matter where you are, they're very competitive. Yeah. Banks want to lend on quality income producing real estate assets, especially multifamily. They look at it as a good risk to take. It's a low risk to lend on. And they're going to look at the operator, they're going to look at the owner, they're going to look at the track record, they're going to look at the rents, the income, the net operating income, and the cap rates. They're going to look at all that stuff. It's very commoditized. I can shop an acquisition or a refinancing to a bunch of local and regional banks. I can shop them to the federal agencies, Fannie Mae and Freddie Mac. I can shop them to Wall Street. The CMBS market will take a lot of these deals. And there's so much capital chasing loans for real estate that you're going to get very competitive terms. So, yeah, I have to like the people that I'm going to be doing business with, who I'm going to be borrowing from and making monthly mortgage payments to. But I have to love the terms. The markets move so quickly and it's so competitive, George, that your terms are really only as good as the current deal that you're showing me. I don't care if we did 10 deals before. If your bank isn't operating in the most competitive way in my marketplace, I'm just going to go to the bank that is. Yeah. And these banks, it keeps them honest most of the time. I mean, it's very, very competitive. You'll see that the local banks, usually don't offer the most competitive terms, but they're local. So you'll walk in, they'll say, "Hey, Peter, how are you today?" And maybe that makes you feel good. The regional banks, some of them will be the same way as the local banks. You'll have a relationship. They'll require your security deposits. They're going to require your operating accounts. They're going to require your personal accounts. They're going to try and get all the business out of you that they can. Credit cards, ATM cards, mortgage for your house, mortgage for your building. They want to do the auto loan on your trucks and vans. But
sorry to interrupt, but is there an advantage to consolidating those kinds of businesses?
Sometimes it depends on you. Here's what the big guys do. The big guys will shop loans to the big agencies, Freddie and Fannie, and the big banks. There's a network of national real estate lenders that will just put money out and issue term sheets. And the big guys are going to just look for the best terms and the cheapest cost of pricing. And they're not going to have a whole banking relationship with this lender. They're not going to have their auto loans and all that stuff. I mean, imagine if you were one of these big players in multifamily that owned 10,000 units across multiple buildings in 30 of the 50 states in America, right? There's no way you're creating a personal relationship with each bank in each market. There's just no way. So they'll go to one of these national real estate lender pools and they'll just get a bunch of bids and they'll put the cheapest debt they can find on their building in that market. Now, they may save the personal banking relationship for their local market where they live, where their office is. They may have something unique in that one instance, but if they're owning and managing buildings in all these different states and all these different cities, there's just no way to do that unless you bank at BOA or Chase or something like that, and there's a branch at every location, and it's impossible. So they go with the national lending platforms, and they get very competitive bids.
Are there any red flags that you look for in terms of, you said it's very competitive, so is there anything that you'd be like, oh no, I'm definitely not doing that. I'm not moving forward.
When you shop for loan terms, it comes down to loan to value, proceeds, how much they're willing to give you. They're going to have to get an appraisal and size up your asset. It's going to come down to recourse or non-recourse and what that looks like. There's different ways to skin that cat, either fully non-recourse or full recourse or some sort of variation in between. It's going to come down to pricing, the interest rate, what's your cost to borrow that money from these people. It's going to come down to, is it a 3, 5, 7, or 10-year loan? You're not going to really get more than a 10-year loan on a commercial real estate asset. And then there's going to be other things like debt service coverage ratio requirement that you have to then maintain once they give you the loan. Some people have a stricter debt service coverage ratio requirement than others. Some people have more reporting requirements than others. Some people want to escrow for tax and insurance while other lenders don't. You're going to have to weigh all of that up. It's all standard stuff in a suite of loan terms from your lender that you're bidding to. You got to get it all together. You know what's funny is that to this day, it boggles my mind. I know a lot of very successful people. Invariably, a few times a year, some of them will say to me, well, what's the interest rate that you got? I'm like, what do you mean? Well, Peter, we're in this deal with you and we're investors and we're friends and we've done business for a long time. Here you are, you're getting a new loan on this property. What's the interest rate? Well, Bob, the interest rate is, 3.5%. Oh, Peter, well, I found out from my bank that they're doing 3.35%. Look, it's a suite of terms. It's not just the interest rate. Interest rate is pricing. When we say what's the pricing on the loan, we're talking about the interest rate. It's one of many things that you have to look at. Yeah. I mean, we get full loan to value that we're looking for. We get the recourse terms that we're looking for. We get the non-requirement for a full banking relationship that we're looking for, because I have to have an office that runs banking efficiently. Right. You can't do that with banking relationships with 82 different banks. Yeah. So, you've got this very smart guy saying to me, well, my bank can do 3.35. Oh, but can they do the same 75 LTV? And can they do non-recourse? Oh, well, no, they can only do 60 LTV and it would have to be partial. So, it's not just the interest rate. It's not just about the pricing. And for those of you out there that think interest rate, what's the interest rate? It's just one of the many things you've got to be looking at. Make sure you're looking at the full suite of terms.
Yeah, it's the global picture.
Yeah.
I have 2 Zest questions for you, Peter, but is there anything else you want to touch on before we move on?
I feel like I'm a little jacked on sugar from the chocolate macaroons that I had before we started, George. Am I a little?
Yeah, I think it's good. It's good energy.
Yeah, is it?
I think so.
Okay,
yeah.
well, give me your zest,
All right,
please.
cool. Sounds good. So first one is, it's actually related to your macaroons. What was the dinner table conversation in your family growing up? And do you feel like that's similar to the conversations that you have with your own family at your dinner table now?
So we had several dinner conversations growing up. I grew up the youngest of 4 boys. There's a 10-year age difference between myself, the youngest, and the oldest. So as the youngest, here's what my experience was at the dinner table. It was at the end of dinner, after dessert, when we're ready to all clean up. The kitchen's a mess. My mom, God bless her, cooked for family of 6 people for forever. And, we had to clean up the kitchen. So here's what would happen. My dad would say to my oldest brother, Hank, take out the trash. And Hank would look to the next oldest. Jeff, take out the trash. Jeff would look to the next oldest. Scott, you're up, take out the trash. And Scott would look right at me and say, Peter, you're the youngest, take out the trash. So you know what I did? Every fucking night, I took out the trash. Rain, sleet, snow, wind, I was the trash man in our house. And there was a lot of things that we spoke about, but that happened every night. Every night. I didn't get out of it once. It was always the youngest person's job to take out the trash because it was the suckiest job. Right. So I had to do it because I was the youngest. They all did it. They paid their dues. But then when I came along, I rescued them. And I was the youngest. So I meet Peter Siegel, your trash guy.
So do you still take out the trash?
Well, I've recently told that story to my daughter. And I've tried to get her to take out the trash, but she's not big enough to actually lift the trash bags yet.
Got to hold off a little bit.
Yeah, so I still take out the trash, is the answer to your question. I'm still the guy that takes out the trash. I like it.
I was going to say, it's done pretty well for you.
I like it.
Yeah, no, excellent. And then last question, what's a piece of art that continues to influence you and the way that you live your life? So, like, for example, in my life, I have a West Wing addiction. I've consumed that TV show from the early 2000s over and over again.
Okay.
And I find that leaking into a lot of parts of my life.
Am I allowed to include non-fungible tokens in this discussion? Because I'm really interested in this, and it's brand new for me. It's brand new for all of us, but I'm really into the NFT movement that's going on. I recently saw that there was an NFT that sold for $500,000. When I looked at it, it looked like an excerpt from like a Donkey Kong video game. I mean, it was completely like lo-fi, low rent, looking highly pixelated with like a Super Mario Brothers looking kind of guy riding like a carpet cloud through a rainbow. $500,000. Wow. Unbelievable. But I promise you that when we speak in the future, I'm going to know more about the NFT buzz that's going on because I'm fascinated by this.
I was going to
stuff.
say, was that the monetary value of what the token represented, or was that the actual...
The guy made it. He signed it digitally. It sold for $500,000.
That's wild.
God bless. Yeah. Right? I mean, I don't get it, but, I understand that NFTs have a real future with commercial applications, with brands and advertising, so I'm excited to see where that all goes. I don't know that I'm running out and purchasing NFTs right now, but I'm really interested in learning about it. I don't want to let it pass me by. I want to know about it. It's happening in our world.
I saw that the search results for NFTs went up, I believe, like 800%.
Yeah, I saw
in
that
too. In the last
I saw that
2
too.
months.
Well, it got me interested. I saw that, and here we are talking about it. So, I also, for you mentioned a TV show. For me, I'll mention music. So for me, it's Bruce Springsteen. I have a very emotional and visceral response to his music ever since I was a young kid. And here we are filming in Asbury Park, New Jersey. So the connection still is there today, and it resonates with me today, and it makes me feel things emotionally that other things can't. So I will list that, and I will also say that my daughter, who I talk about a lot here with you, is an aspiring artist. She's always doing projects and drawing and painting and sketching and doing things, and I love everything that she makes. I think it's all great. I collect it, I save it, I put it up on the walls. I have a big box of stuff and books that I make of all of her artwork, and
it's beautiful.
That makes me feel all sorts of happiness. So those are my 3.
Yeah. So the big boss and the little boss.
Right.
Your 2 favorite artists.
That's right.
Yeah. All right. Well, thank you so much, Peter. Appreciate it.
Thanks, George.
I'll see you next week.
All right.